Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, Head of UK Rate Strategy, and I'm joined today by our global market specialists, Giles Gale and Kevin Cummins. Now, we've got a super busy week looking ahead. I think I said in December, I don't remember the last time that the ECB, the Fed, and the Bank of England were all in the same week. And here we are in February, well, almost in February, with them all in the same week again. Feels like it's got a little bit less hype around them all this time around than it did in December, but perhaps that was just a bit of year-end euphoria. But nonetheless, let's kick off with the Fed then, Kevin. I guess we're going to have pretty similar questions for each other around what we're expecting, but let's start in the US. So what are you expecting, I guess, in terms of how big the hike might be and also what they might signal about the kind of future pace or size of future hikes?
Yeah, sure. Well, I think it's pretty much a moderation in the path of hikes here again, in that we're only going to get a 25 basis point rate hike. Seems like it's a virtual lock. But I think you touched on a interesting idea, is the prospect for the future. As is often the case, the key issue is what they say about the future, really, than what they do at the actual meeting. It seems like they very much have teed up a 25 basis point hike for next week. And the backdrop hasn't changed that dramatically from the last time the Fed met in December. Inflation risks may have moderated a little bit, and the risks to economic growth have certainly increased, notwithstanding the pretty encouraging GDP print for the fourth quarter that we got. But I think the overall tone that we're going to come out of this from Wednesday's meeting is that it's still a bit too premature to be thinking about pausing the rate path going forward. So I think the message from Powell and company will be that they're going to continue to move rates higher, and it'll obviously be very data dependent. But rates are still going to remain on an upward trajectory for now.
What would you be looking out for then in terms of what could deliver a kind of more hawkish surprise to markets or a more dovish surprise to markets? I guess it's not one of their quarterly meetings with updated projections. So the signaling tools from, to a certain extent are a little bit more limited perhaps than usual, but where would you be looking for kind of hawkish or dovish surprises, and how might the market react to that?
Yeah, I mean, I think the market has kind of run with the idea that the U.S. economy is either tipping or going to be in the midst of a recession at the start of this year. And I think even though there are some members who might suspect that they're getting very close to the rate hike cycle end, they're just not sure enough yet about inflation to be sending a really dovish signal to markets that it's over. So I think they're going to really be careful here in their wording in the statement, because this coming meeting, we're only going to get a FOMC statement at 2:00 Eastern Standard Time, and then Powell will go before and have his press conference at 2:30. So there's not going to be any sort of updated economic projections or summary of economic projections or the dot plot, that stuff we got in December. And I think Powell will be he could. I mean, he's done this in the past where he'll look back to the last dot plot, which showed the median estimate at 5.25, so the terminal Fed funds rate, still implying another 50 basis points in hikes after the expected 25 basis points next week, and say that's still a reasonable guide to expectations. So he'll kind of manage the narrative here in what sort of expectations to give markets. Markets certainly don't expect the Fed to go over 5%. That's priced into the Fed funds market. But I think the Fed's message is not going to be all that much different than what we saw in December. Now, the wording of the statement will change a bit. The current conditions paragraph, we'll probably have to downgrade the growth perspectives a little bit, and we'll probably sound a little bit more positive on the developments on inflation. without really showing too much encouragement there. But I think, with regard to forward language in the statement, I don't think they're really gonna. I think they're gonna very much try to keep things in perspective, that the expectation is that they keep moving slowly higher depending upon the data in a more gradual fashion. So I don't think it's going to be a big rewrite there. But I do think it does require a few tweaks here and there. The Fed right now says that in the statement with regard to forward language, they say ongoing rate hikes will be appropriate in order to sustain sufficiently restrictive policy. That ongoing reference is probably going to be downgraded a little bit, just to signal that some further increases in the funds rate or something to that extent, rather than having policy on autopilot. Obviously, they're going to be hiking again next week. That seems a bit stale to just keep it on autopilot of ongoing rate hikes when they're getting probably closer to the end in sight. But they're going to probably avoid signaling that rates aren't necessarily going to go up from here. The other thing is they're going to change the narrative a little bit and stress the importance that policy is going to remain restrictive for some time, that providing a little bit of guidance to the market that they expect rates probably to remain at these levels for the rest of this year. Now, of course, things can change, and it's not a hard fast rule that they can't cut by the end of the year if conditions warrant it. But I think right now what they know and what they expect to see on the economy and inflation, that once they get to this level, they want to pause and see how things evolve in the overall economy.
Okay, no Bank of Canada from the Fed then. Kevin, I will come back to you, but I think while we're on central banks, let's just stick with that and rattle through what else we're expecting next week. So Giles, over to Europe and the ECB. Very similar questions for you then. What are we expecting, and what are you expecting in terms of the guidance around the future pace of hikes and the frequency, etc.?
Yeah, I mean, it's not that hard a question to answer, to be honest with you. I think that 50 basis points is the market's expectation, quite rightly. I think we would all be astonished if they didn't raise rates by 50 basis points. So, I don't think that's really what we're looking for, especially. Clearly, it's mostly going to be about the messaging. Looking ahead to March and beyond, the market is pricing in about 3.4%. We still think that's too high, but I think that you're not looking for the ECB really to say anything that would really shift market expectations about that just at the moment, to be honest with you. We've had some decent data in Europe, notably the business surveys. I think a lot rides on this inflation flash report that comes out just before the ECB. Not so much for the language that they choose to use in that meeting itself, but for that will feed in. I mean, that'll be one of the most important data points, I think, that will sort of feed into the expectations about March, where I think that they will signal that they fully expect to follow up with another 50 basis point rate rise. And so a big question is whether they continue to use this steady pace language, which was designed to tell us back in December that they wanted to raise rates by 50 basis points twice or probably three times in a row. And I think your base case is that stays in.
What about QT? Is there anything else that we should or could expect next week on QT? Quantitative tightening, that is?
Yeah, I mean, again, there will be more details, but not that we really care all that much about, to be honest with you. It's, it was supposed to be the other way around, really. They were supposed to give us the details in December and then, follow up with an announcement about what they actually intended to do in terms of when they were going to start, how fast were they going to go, and so on this month. And they sort of switched it up and gave us the announcement already. So, that's kind of already in the bag, if you like. there will be some stuff for geeks like us to analyze, but nothing I think that we need to talk about in all that much length right now. I mean, the main thing is just which programs will be affected, base case, all of them, and will they maintain a similar level of flexibility over time and across programs as they currently do? Answer, yes.
Okay, fair enough. I guess just to finish off on the ECB then, I guess similar question to Kevin, what would you be looking for? And I suppose if 50 bips you think is kind of nailed on in terms of the size of the hike, this all comes down to the guidance again, but what would you be looking for if they were wanting to kind of be a bit more dovish or a bit more hawkish than the market is currently expecting?
Yeah, I mean, the key question that everybody seems to have at the moment is, given how hawkish they already have been, what can they possibly do if they want to be even more hawkish? And it's not an easy question. I think that I already mentioned the steady pace language, and I said that I think that there's a pretty strong base case that stays in, but there is a risk that it's softened. So I think just leaving it in is a little bit hawkish. She also talked about being in the long game, in for a long game, or words to that effect. I think by including that in the Q&A, that's sort of just by force of repetition, I think that she could strengthen this steady base language. And the other thing is that in the Q&A, and then again in Davos, Lagarde talked about investors needing to revise their positions. That was really the strong message back in December, when the market was pricing in a bit less than 3% as a sort of terminal rate for the ECB. And clearly the feeling was very strong at that point that wasn't enough. Well, we've moved in terms of market pricing 50 basis points since then. I do think that she should acknowledge the increase in expectations and sort of say that they'll review in March in the forecasts, because one of the things that she said last time was, we can't forecast inflation coming back to target anything like the rate we want based on where markets currently have. So basically markets price in more. I think that continuing that sort of rhetoric, that sort of argument would be pretty hawkish, and I don't because there's not obviously a need for it. On the other side, what would be dovish? I mean, there's plenty of things, but mostly just the discussion of things like the skew of risks and around growth and inflation. In particular, the inflation risks were on the upside, for example. Another thing that they could do to be a little bit hawkish, I suppose, would be to just sort of strengthen the economic risks assessment. So also these lots of things to look out for in the details.
As ever.
Imogen, onto the Bank of England. What are you expecting? What magnitude of rate hikes, and what do you see about signaling and the vote and all that kind of stuff?
Okay, so we have a 50 basis point hike penciled in as well. I think it's probably a bit less clear cut from the Bank of England than perhaps it is, as you think for the ECB, or as even Kevin went through for the Fed. Markets are pricing about 45-ish basis points. So it seems like consensus is still in the 50 basis point, direction, but there's definitely a few out there who are calling for 25. So I don't think it's as much of a done deal, but nonetheless, we are in the 50 bip camp. But a kind of terming this as a dovish 50 basis points. So think that it comes with a dovish skew in the vote. We're expecting 6 for 50, 1 for 25, and then 2 for unchanged. So what that means is Man, who's kind of always been the hawkish outlier and has consistently for the last few meetings been voting for a 75 bip hike, now folds into the 50 bip camp. And then you also get one of the more dovish centrist members voting for 25. So we've put Cunliffe down as our kind of candidate for potentially voting for 25. And then the two doves, Dingra and Tanrera, who voted for no change at the last meeting, also voting for no change again. And then, similarly with how we've been talking about the Fed and the ECB, will obviously be closely watching the guidance and how they change that, if at all. we think they do change it, probably by just tweaking the reference that they currently make to, I guess, the conditionality around how forceful future rate hikes might need to be. They currently say the committee continues to judge that if the outlook suggests more persistent inflationary pressures, it will respond forcefully as necessary. I think they could qualify what they're looking for when they talk about those inflationary pressures a bit more clearly, what exactly their indicators that they're watching, and how how they might determine those as being more persistent. They could, of course, do away with the forceful reference altogether, but I think that would probably be a dovish surprise. Or they could leave in that same sentence around, if the outlook suggests more persistent inflationary pressures, it will respond forcefully as necessary, but then add in a counterbalancing kind of more dovish side to that sentence, that if inflationary pressures, God, that's a bit of a tongue twister, start to abate, then they might look at kind of slowing or pausing in this hiking cycle. So it's kind of the vote and the guidance that we'll be looking for to take our cue on whether this is a sort of hawkish 50 or a dovish 50. But we think that on balance, it's more likely to be a dovish 50 than a hawkish one.
Okay, I guess that we've been sort of walking through this as a bit of a pro forma, just because there's always so much focus with listeners and market participants in general on what am I looking for a hawkish, what am I looking for a dovish meeting. Sounds like you've covered that pretty well there already. The other thing is the monetary policy report is going to be coming out with updated projections, and maybe you could just tell us a little bit about what you're looking for the forecasts to tell us, and what kind of message we should be looking for there.
Yeah, I guess I should just qualify this and well, I guess explain why I didn't use these in the first part of my answer. Is, I think that markets generally have sort of disregarded the forecast to a certain extent as a kind of policy guidance tool, partly because there's been a huge disconnect between what the forecasts have been telling us, or what the forecasts imply for the direction of travel of monetary policy, and then what the kind of reaction function on bank rate has actually been. If you remember back in November, the forecast at the 2 and 3 year horizon had inflation well below the 2% target, yet the MPC was hiking by its biggest ever increment. So there's been this sort of ongoing disconnect between what you might infer from looking at the forecast alone and what the MPC have actually been voting to do, which means that I think from a kind of markets perspective, the forecasts themselves have taken on a lot less importance. And that's why I think, as I said earlier, the reaction will be driven really just by the vote and any changes, if at all, around the language. But just for completeness, I guess what will matter most on the inflation side for the forecast since the November report are that we've had a huge repricing in bank rate expectations. So back in November, they premised their forecast off a peak in bank rate at 5.2%. We're about 80, 90 basis points lower than that now. So that will clearly matter for inflation expectations over the kind of 2 to 3 year horizon. And also, what's much more important for the near-term horizon is the fall that we've seen in natural gas prices. And I think we talked about that last week in detail, about how that's kind of influenced our own inflation projections. But nonetheless, it's kind of the 2 to 3 year horizon that I think matters more for the kind of policymaker, or policy guidance at least. So on the inflation front, we are looking at a raise in their inflation expectations, I think, on a kind of market-based assumption, which is where they use what the market is implying for bank rate in their forecast. We get inflation in the 2 year point at 1.7 and at the 3 year point at 0.5. So that's about a 30 basis point uplift in the 2 year horizon and close to 50 on the 3 year horizon. And the majority of what is driving that, as I say, is this kind of revision in bank rate expectations. And on the GDP front, probably likely to be slightly less market moving again than even the inflation forecast, but we expect a marginal uplift in their forecast there. So we have GDP in 2023 on the market rate assumption going to -1, up from -1.5, and in 2024 up to -0.25, up from -1.
Okay then, Imogen. Away from the Bank of England, then there's been some supply focus again this week. The markets may be thinking about downside risks to energy, prices, and what that means for funding, and also perhaps other forms of funding. Just given how much gilt supply is expected to step up, maybe the DMO and the Treasury need to think about ways to soften that. Maybe you could just talk us through a little bit, what the supply risks that you've been thinking about are.
Yeah, I guess they are the two major downside risks we've been thinking about to that headline gilt supply number. I think on the energy front, I think I made this point last week, but I'll repeat it very quickly just in case I didn't, that, markets would be wise not to get too carried away around the kind of funding impact of lower energy prices. The cost of the EPG, the government's energy price guarantee, was only estimated at 13 billion for the next fiscal year anyway. So when we're talking about gross financing needs of kind of 300 billion, that additional 13 billion, even if that goes to zero, isn't really a huge saving. And of course, that will then be offset by lower tax revenues from the windfall taxes, and probably likely some of that expenditure might be recycled to other places anyway. So I don't even think we're talking about a total net saving of 13 billion. But for argument's sake, even if we were, that is obviously a very small proportion of that kind of 300 billion number. I guess the more new news this week came out of the Treasury's annual meeting with GEMS and investors. And that was just this idea that, as you say, Giles, they might look to diversify their funding sources to alleviate some of the supply pressures that would otherwise have to be done via gilts. I think there's two obvious ways that they could diversify those funding sources. The first is via bills, and the second is via more investment from retail, from households essentially, and that's something that the UK government do already. They have this national savings and investments, NS&I, premium bonds and ISAs that are held with NS&I, but something that could be expanded. And this is something that's done, I guess, more commonly in Europe. You think about things like BTP Italia, Futura, the Livre A in France, and perhaps their models that the UK government might look to emulate, particularly Livre A, I think, in order to kind of tap into some of the excess cash, if you like, that has grown since COVID, and there is a fair amount of kind of cash sitting on, with banks essentially, with households. We estimate that there's about 1.7 trillion. Not we estimate, BOE data tells us that there's about 1.7 trillion of household cash sitting in banks' balance sheets, which obviously could be put to some other use. But it's probably important, again, for markets not to get super carried away about A, how cost effective this might be as a source of funding for the government, and B, how much of that cash might actually be redirected back towards other sources if the government were to create kind of new savings and investment products. I guess in the most optimistic scenario, if you're thinking about how much they could use bills and other sources of financing, you might think about them cutting the total supply via gilts, and this is in a very optimistic scenario, by about 70 billion next year. And that sounds like a big number, but actually when you put that into context of the total funding needs this year, it still means that gilt supply, net of Bank of England and net of redemptions, and of course the Bank of England's an important factor there, given that they'll be doing, they've switched to doing QT rather than QE as they have been doing in years gone by, but actually that net number will still be double in the next fiscal year than it has been in this fiscal year, and remain very high for years to come. So I think there are some downside risks, but not hugely significant that would really deter our bearish conviction at this point. I guess to contextualize how we think about supply in terms of, our 10-year gilt target, all else equal, I think a change of about 50 billion in net supply adds or takes away, depending on which direction the change is, about 15 basis points off our fair value for 10-year gilts. So yes, it might trim our kind of current 4.1% target to the downside a little bit, but I don't think we're talking about a meaningful shift here in our kind of outlook outlook for the direction of travel for gilts?
Right. So bottom line then, although you've done quite well in your premium bonds recently and you'll be rushing down to the post office to max out, it's actually not going to be all that significant, and it's not really going to change your view on gilts. Okay, I got it.
You are correct. I should have added a disclaimer there. I did win big recently. And by big, I mean £700, which is big in my books for a normal £50 winner. Yeah, that's right.
Yeah, so the other question then, maybe to round up on the UK for today, is that next week we have long end QT. So maybe you could just tell us how you expect that to go.
Yeah, the first long end QT auction ever, well, of regular sales. So I guess kind of long awaited, but really not expecting much in terms of excitement. I think that it will probably be relatively well absorbed. I think that perhaps some kind of month end flows and also the big index extensions that we're expecting at the end of this month, given, the syndication and some coupon payments and the redemption as well, all probably mean that there will be enough demand for duration to absorb that auction relatively well, I think. So an exciting day in the calendar, but perhaps not particularly exciting in terms of market reaction. Okay, that's probably enough on gilts. Giles, back to you then, because aside from the ECB, one other thing we've been talking about a lot this week is how well risk generally has performed at the beginning of this year, and BTP spreads are no exception to that. You talked a little bit when we were talking about the ECB about the flexibility and those sorts of things, and of course they all matter for BTP spreads. So what's your outlook from here for Italy?
Yeah, I mean, you're right. We've been thinking quite a bit about Italy because not only has it not been an exception, it's more than participated in the rally in credit. And while it was sort of to begin with, just kind of swept up with credit on a reasonably predictable beta, it started to outperform and got to levels on outright spread versus Germany, which I think were a little unusual, and certainly I opened a few eyes. And so thinking about ways to fade that, really, because at the moment it's really market directional. Essentially what's good for rates is good for Italy. Lower rates is good. It's good for credit sentiment generally. It's good for sentiment around Italian debt sustainability and so on. And conversely, higher rates, you tend to see a spread widening, and that's really the biggest thing that's going on because this isn't a crisis sort of environment for Italy, and so just getting the way that beta trades gets you a long way towards sort of setting up a market neutral trade, which then allows you to focus on the fact that actually, in a lot of ways, Italy does look quite expensive. It's done very well this year. I think that funding risks will start to matter more after the ECB. We'll start talking about quantitative tightening. Whilst ECB flexibility is great as a backstop for Italy, it does work in both directions. And in principle, Italy the total holdings of the ECB of Italy are somewhat overweight and do need to be reduced a little bit. And so I think that all of these factors suggest that actually, if you can think of a clever way to be short Italy, then it's worth looking at. And so, what my suggestion has been is to try and do this on a sort of volatility weighted basis. So that's it. Enough on Italy. I think that there's the germ of a good idea in there, and in fact, I've written about that in a couple of notes for those who do have access to our stuff and can read it.
Okay, nice little teaser there. Let's wrap this up then with one final question for you, Kevin, because it's not just the Fed next week. We also have NFPs. We will be recording again before NFPs, but Jan usually gets the misfortune of having to record on a Thursday, knowing that no one's going to listen until Friday afternoon after the print is obviously out. So how important are they really going to be, and what's your expectation, I guess?
Yeah, so we do think that we're going to see some more moderation in the trend in payrolls out next week. But alongside the January data that we're going to also get revisions for payrolls, for hours worked, for earnings data going back a couple of years to show the annual benchmark adjustment as well as updated seasonal factors. So, history is going to be revised going back. The preliminary benchmark estimate that we got last fall suggested that in the level of payrolls in the 12 months ending March of 22 is going to be revised up by just shy of about 40,000 per month over those 12 months. Now, we don't know since then what the revision is going to look like. But, from the Fed's perspective, they're hoping that payroll growth slows down. So if we're right and we're continuing to see moderation in the trend in payroll growth, the Fed is certainly going to be encouraged from the perspective of the wage component there. I would point out next week ahead of the FOMC decision, we are going to get the Q4 employment cost index. And I think that will shape the committee's perspective going into the meeting, or at least in the midst of the meeting. So the tone that Powell uses, with respect to earlier when we were talking about, if there's risks for upside or more hawkish sounding Powell or more dovish sounding Powell, I think that ECI report is really key because he has flagged that in the past as reason enough to change his views. And a few years back, he pointed to that report in particular, that when they were getting out of asset purchases, that being a really key report. So I think we're likely to have some potential fallout around that report in the meeting, but they won't have the employment report 2 days later. So between now and the March meeting, I think there's ample time for them. They'll have 2 more CPI reports, a couple more jobs report, including this annual revision of payrolls, that if they want to signal a pause this spring, there's some time to do it, and they don't necessarily have to begin that process just yet at next week's meeting.
Okay, lots to watch out for between now and then. All right, great. Thank you both for joining me, and thank you to our listeners for tuning in. Just a reminder that if they liked today's episode, please don't forget to hit the like button and click subscribe so you can get the latest episode as soon as it's available. Thanks, see you next week.